Since I started posting personal finance content, I've had a ton of people asking me the same thing. Am I too old to start investing? If you're 35, 45, or even 55 and think you've missed a boat, that belief could cost you hundreds of thousands. Not because you're too old, but because you're about to do nothing. In this video, I'm going to outline exactly why that thinking is completely wrong. I'll highlight some surprising returns you can make even if you're a late starter, and at the end of the video, I'll go over some tips for anyone that wants to get started but feel like they're a little behind everyone else. Let's go. Before we dive into the heart of the question, we need to understand why people may feel like this in the first place. And to illustrate this, we're going to look back at two of our childhood friends, Kenan and Kel. We're going to use our friends here to show just how important investing is and why so many successful people use it as their foundation. You see, Kenan here, he was a bit of a prodigy. He thinks he can take over the world, sky's the limit. He's switched on and he starts investing at 20 years old. He invests £5,000 a year until he's 30. So that's just over 400 quid a month. He invests that £5,000 a year for 10 years, meaning that by the time he's 30, he's invested £50,000. Now this is the really important part. After those 10 years, Kenan doesn't add a single penny, but he keeps that money invested until he's 60. Meanwhile, we have Kel over here. See, Kel wants to enjoy life. He loves to party, and rumour has it that he enjoys an occasional shot of orange soda. But Kel's no dummy. At the age of 30, he decides to start investing £5,000 a year. But unlike Kenan, he doesn't stop after 10 years. He's got structure now, and he's committed to investing £5,000 a year for 30 years until he's 60. So in total, Kel invests for 30 years and puts in a grand total of £150,000. Now, let's just say they both invested their money in the exact same fund, and that fund gave a return of 7% a year on average. You know what's coming, right? Who do you think had more money by the time they were 60 years old, Kenan or Kel? Pause the video and let me know in the comments. Okay, check this out. At 60, Kenan has a grand total of £589,000. And remember, he only saved and invested for 10 years. Meanwhile, Kel has a total of £510,000 and he saved for 30 years, putting in 3 times as much as Kenan. Madness, right? Now, if you're in your 20s and you've stumbled across this video, congratulations, because you've just found a blueprint. But on the flip side, if you're in your 40s or your 50s, it's easy to see this data and get discouraged. You think, well, I've missed the boat. What's the point in investing? I'm screwed. Well, all this example does is demonstrate the immense power of compound interest, which we touched on in last week's video. But this example is flawed, not because the numbers are incorrect, but because it doesn't factor in the most important part of personal finance, and that is human psychology. There's actually a term for this, and it's called upward social comparison. It's when we compare ourselves to a perfect, often unrealistic standard or expectation. Think about trying to get in shape to improve your health and fitness. You open up Instagram or TikTok and you're bombarded with these young trainers with incredible physiques. A lot of them actually put out some really good, useful information, but instead of feeling motivated, our subconscious compares ourselves to them, and the end result is that we end up feeling worse about ourselves than when we started. Next thing you know, you're drowning yourself with a full fat Coke and you're sat on the sofa with a full tub of Ben & Jerry's ice cream. It's the exact same thing with money and investing. Often we only see the end result or hear about the success stories. These perfect examples, like the one I mentioned earlier with Kenan and Kel, they don't exist in the real world. Trust me, when I was 20, my main concern was how I'm going to get into a club when I'm in a group of 5 lads and 3 of us have trainers on. The last thing I was thinking about was an index fund or how can I pay lower fees. So what's the first thing to do? Just relax. Don't be so hard on yourself. We all run our own race, and remember, there's no such thing as perfect. The main thing is that you're here now watching this video and you're making tiny steps towards a better future. That's the real flex. And trust me, that's more than the majority of people out there. And if we look specifically at those in their 40s and 50s, you have a ton of things going in your favor that you can definitely take advantage of. Your children are becoming older and less dependent. You probably have a decent amount of equity in your property, and over the years, you've probably improved and progressed in your career. You're practically primed and ready to attack investing from a solid foundation that you've built over the years. Stop thinking, what if? It's something I personally struggle with, so trust me, I know it's tough. But focusing on today and the actions that you can take, those are the things that drive significant change. The funny thing with the Kenan Kel example is, Kel's absolutely smashed it. Imagine retiring and providing his investments were inside of an ISA, you have access to over £500,000 tax-free, plus whatever pensions he may be a part of. I don't know about you, but I wouldn't mind being Kel. Reframing retirement. One thing I think we get completely wrong when we talk about investing is how we frame retirement. We talk about it like it's the end, like it's the finish line, like once you get there, life just stops. As if you hit retirement age and that's it. No plans, no growth, no future, just you sitting in a rocket chair watching daytime TV. But when you look at the reality, that framing just doesn't make sense at all. The recent stats show that in the UK, if you make it to 65, you have on average between 19 and 21 years ahead of you. That's not the end, that's another chapter. So when people say, what's the point in investing now? I'm too old. What they're really saying is, I've misunderstood the timeline. Your money doesn't stop working because you stop working. In fact, that's often when we need our money to be working the most. We've been conditioned to think, save until retirement and then forget about money. But here's a better way to think about things. Investing isn't about reaching a certain age. It's about supporting a lifestyle that you want to maintain. Whether that's travel, helping your children, staying independent, or you just want options. So if you're watching this thinking, am I too late? You're not. You're right on time. Okay, now we've put to bed some of the psychological barriers that stop us investing as we get older. Let's look at what we can do moving forward. Remember, the main reason we want to invest is to beat inflation. You may not notice it day to day, but over years, it will certainly eat into your savings. The primary engine to grow your money is equities. Now, I can't tell you what to invest in, and to figure out how much you should invest into equities, you need to figure out your risk tolerance. Risk is another topic in itself, and we'll probably save that for another video. But remember, you may need your money for another 20 to 30 years. And you still want your money working for you throughout this period. You don't want it just sitting there in savings, losing the battle to inflation. While we want our money to grow during retirement, we still need to be smart in the way we deploy our funds. And that is where diversification comes in. Basically, you don't want to invest all of your money into one particular thing or industry. Think of it like putting all of your eggs into one basket. You want to spread your investments, which will reduce your overall risk. That way, if one particular element doesn't really do as well as you'd hoped, your pot is still intact. This can be achieved by using something called an index fund. And if you wanted a full breakdown explaining what an index fund is, then you can find it here on my channel. I have a full breakdown going over all the basics. Another reason why this style of investing may be appealing to an older investor is because it's less stressful. At this stage of life, the main focus should be enjoyment. You don't need to be stressing about what the financials are of Apple this quarter. Having peace of mind is priceless. And the best investment is the one that you can stick with no matter what the headlines say. It's like diet and exercise we spoke about earlier. When I was in my 20s, I'd count calories, make sure I was exercising efficiently, and checking every box. Almost 20 years later, and I couldn't think of anything worse. I diet and exercise, but it's more like 70 or 80%, but that is just fine. It's the same thing with investments. Don't stress about the absolute best return or what's the optimal strategy. At this stage, good is good enough. I think mental peace and enjoy in your later life is more important. Let's face it, that's where the real wealth is. Think about this. You're in your 20s or 30s and you know the benefits of investing and starting early and letting that money compound over time. However, you live in the real world and your next goal may be to buy a property, or you might want to pay off some unwanted debt. Shifting your focus to these goals and not having long-term investing as your primary goal is perfectly normal. Just like someone in their 70s or 80s, they may be investing for their children or grandchildren. They may have no intention of ever seeing that money themselves. In both scenarios, the individual has completely different goals and strategies, and they're both perfectly fine. The problem is, retirement age doesn't really factor that in. Even if your retirement age is in sight, keep contributing to your pension. It's a fantastic way to be tax efficient due to the relief you get. And also, if you're employed, you get your employer's match, which is a guaranteed return on your investment, and you won't get that anywhere else. One thing that can really add up over time and eat into your investment are fees. And this is the one thing that we can control because we know what they are up front. Let me show you a quick example of how fees can really add up. If you invest £500 a month for 30 years and earn a 7% return, you end up with around £610,000. Now let's just change one thing. Same investment, same £500 a month, same 30 years. But this time, fees and taxes reduce your return by just 1.5% a year. Your final pot drops to around £457,000. That's a difference of just over £150,000. Not because you did anything wrong, but because fees compounded against you. People obsess over picking the perfect investment, but they ignore the one thing that they can control from day one: the costs. No shortcuts. When starting late, it's tempting to want to get a jump start on your investing, especially if you have a bit more disposable income. You feel like you want to make up for lost time, but a word of caution: this can open you up to the lure of temptation. There will always be something that's new and shiny and it's the talk of the town, whether it's cryptocurrency, NFTs, or a new AI technology. There will always be something that seems like the next big thing. But just remember, these big returns often come with big risks. And when you're an older investor, is this really the right time to be taking on those bigger risks? If you take one thing from this video, let it be this: you're not behind, you're not too old, you're just aware. The people that lose are the people that do nothing because they feel it's too late. Start small, keep costs low, and stay consistent. And if you want help with understanding the fundamentals of investing, then check out this video. And on that note, I'll catch you in the next one.